So in this video, I'll talk about the 4 things that can affect the real estate price in your market. And make sure you stay until the end, because the last one is what I like the most and what could trigger the most short to medium term price change in your market. So number 1 is population. If you look at population growth from a 5 to 10 year time frame, then you can predict the housing price for the next 10 to 20 years. From my previous video, I already mentioned that the housing is necessity. So everyone wants a roof over their head, either they're renting or they're buying their own home. So a really easy way to predict whether the housing price is gonna go up is look at the population pyramid for the market you are investing in. Because if you look at the population pyramid, you can predict for the next 20 to 30 years who will be buying these houses, if there are anyone buying these houses. So the first type of population pyramid is actually a pyramid. So at the age group from 0 to 80, at the top, if you have a small amount of people, but at the bottom you have a lot of people, it just looks like a pyramid. That means for the next 10, 20 years, these people down here will grow up to the age where they will start buying real estate. So that's a really good sign. Now, if our population is a reverse triangle, that means that there's a few newborn baby and all the population is very heavy on, people are retired, are not really producing much for this economy. So that's not a really good sign, because there's less people that will be buying their homes when they grow up. And good example of these aging countries are Italy, Japan, and Greece. When you look at the population change, it's not just the natural population change. You have to also look at the net migration, which is people who are moving around between the city and between the province or states. Now, there are many examples I can use over here, but because I live in Canada and because I live in Toronto, Toronto is the main city in Canada, I will use Toronto to compare with other cities in Canada to demonstrate what I'm trying to talk about. So according to the chart, you can see that for the past 20 years, the price in Toronto has increased from $200,000 all the way up to $1.4 million for a single family house, and this is their median price. Now, if you compare this with Newfoundland, which is a small island that you need to take ferry to on the east side of Canada, the house price only tripled from 2000 to 2022. Now, if you look at the overall national average, the house price has quadrupled between 2000 and 2022. You guys might be wondering, why did the real estate price skyrocketed in Canada over the last 20 years? And the number one reason for this is because of immigration. So 60% of Canada's population change is due to immigration. Since most immigrant has the power, or eventually has the power to buy houses, so it's very important to watch out for changes in the immigration policy, because that might change the net population in Canada. So now the question might come up is, how do you predict population growth? And that's a really great question. If you look at the migration or the immigration for the last few years, and if you assume everything will be the same for the next few years, you can easily draw the line and make your prediction from there. After we talk about the population impact on real estate price, the next we want to talk about the economical conditions that can impact the real estate price as well. Now, generally, the wealthier the country, usually the higher the real estate price, because people can pay for it. A lot of experts also look at GDP, but just knowing that GDP mostly focus on companies' earning, and it's the actual people that the company hired that's buying the house. So we focus more on the personal income side. We look at the average income, median income, and employment rate, because that has a higher correlation to the actual real estate price. Despite all those objective data, it's still really hard even for experts to quantify. So we really have to look at what's driving those economical growth. Is this sustainable in the long term? Take Silicon Valley in California, for example. They hire a lot of highly skilled people. They pay them really well. And these companies are definitely here to stay for the next 10 to 20 years, as technology has helped human advance a lot in our life. Now, on the other hand, if you compare to a small city in Canada called Sudbury, which is mostly relying on mining industry. When the mining industry is doing really well, all the population will move in, the economy will grow, the real estate price will go up. But as the mining doesn't do as well, where the demand is not as high, then the people will actually move out, and then the real estate price might go down. And there's a market cycle shift. So if you're an investor looking for more stability in your return, and you're looking at a market that's purely focused on one industry, you should probably think twice. So number 3 is interest rate. Because if the interest rate goes up, it's harder for you to borrow money from the bank. And even if you borrow money from the bank, the amount will be a lot lower because of stricter stress tests. And vice versa goes for if the interest rate is lower, it's a lot easier for you to borrow more money from the bank because it's lower stress test rate. And let's put this into example. If you have a $1 million mortgage with a 25-year term, and if the interest rate goes up by 1%, that means this house will cost you about $1.1 million now, because you lose 10% of your borrowing power. Now, vice versa, if the interest rate goes down by 1%, that means you only need to pay $900,000 for the house because your borrowing power is up by 10%. And like I mentioned in the beginning of the video, this one you really want to pay attention because this can cause a short-term effect on the real estate price. And this is policy change. And there are many policies that could positively push up the price in real estate, and there are also policies that can push down the price. So the first one that's the most noticeable that can push up the price is the first-time home buyer incentive. So a lot of you guys, if you're saving your down payment for your first house, just knowing that you can actually just pay 5% for your down payment. You don't have to save all the way up to 20%. The government is allowing this incentive to allow a lot of new buyers to buy their home easier. And also the Home Buyers Incentive Program will allow you to pull out about $35,000 as of filming today from your RRSP, which is a registered fund account, to pull it out with no income tax penalty on top. And you can use that and use that as a down payment for your first house. Now, there are also policies that can restrict the price growth, such as if you want to buy your second house, most banks or financial institutions will require you to have at least 20% down for your second property. And also, a lot of Canadians will probably know about this, that the government has been implementing the foreigner buying tax of 15%, 20%, and they're talking about increasing it higher just to curb all these foreigner buyers. So some of you smart people might already figure this out. The first 2 variables, which is the population change and then the economical condition, is more market driven. And then the last 2 factor of interest rate change and the policy change is more policy driven. So for the first 2 variables, which is more market driven, can cause more long-term effect. Now, the last 2 factors of interest rate and policy change can cause a short-term shock, but it's more short-term. So just a quick recap on what's the ideal situation for the real estate price to go up is population growth, very good economical condition, very positive government policy to allow investor or even first-time home buyer to buy a lot more property. Now, something that's worth noticing is that for the last 6 months, Toronto has a housing correction. And all these 4 factors actually works all in favor. So supposing the real estate price was gonna go up, and a lot of institutional investors use the same criteria to gauge where the market is going. So instead of blindly believing all these 4 factors, you really have to make sure that any property you buy as an investment is cash flow positive. That means you're not dumping money into it, you're actually getting paid by every month. And making sure that if the interest rate does continue to go up, your cash flow will still be able to sustain all the payments and you're not dumping money into it. That's the way how you can make sure you can weather the storm and come up on top on the other side. If you want to see more investing content, make sure you hit the subscribe button. If you find anything helpful in the video, make sure you drop a like. And also let me know in the comment section below, do you think the interest rate will continue to go up into 2023? Or do you think the government already overshoot it and they will drop the interest rate in 2023? Let me know in the comment section below and I'll see you guys in the next video.